Hello, everyone. Welcome to episode 7 of 10-Minute Bookkeeping. Today, we're diving into a crucial topic: how entities raise funds for their operations. We'll explore two primary methods for securing financing: equity funding, which involves raising money from owners, and debt funding, where entities borrow money from creditors. By the end of this episode, you'll have a solid understanding of how financing activities work. So when you're ready, go ahead and move on to kickstart your learning. The forms of business ownership have a significant impact on how we account for equity funding. So, let's dive into them first. There are three main forms of business ownership: sole proprietorship, partnership, and corporation. A sole proprietorship is a business owned by a single person. In accounting, it maintains separate financial records. However, legally, a sole proprietorship and its owner are one and the same. This means that if the business's assets can't cover its debts, the court can demand that the owner dip into their personal assets to settle the obligations. This is known as unlimited liability. Owners shoulder full personal liability for the business's debts. On the plus side, a sole proprietorship's income isn't subject to business income tax. It's simply taxed as part of the owner's personal income. Now let's move on to the partnership. A partnership is an unincorporated business jointly owned by two or more individuals. The business's owners are called partners. Generally, partners also carry the burden of unlimited liability, and the partnership doesn't incur business income tax. Instead, its income is taxed as part of the partner's personal income. Now, a corporation is where things get interesting. It's a legal entity entirely distinct from its owners. Shareholders, as they're called, possess shares of the corporation's stock. These shares are represented by pieces of paper known as stock certificates. Shareholders enjoy a unique benefit. They aren't personally liable for the corporation's acts and debts. If the corporation can't pay its debts, shareholders aren't compelled to sell off their personal assets to cover the shortfall. However, corporations grapple with a pesky issue called double taxation. Corporate income is taxed. Then, when shareholders receive dividends, those dividends are taxed as part of their personal income. Now you can see each form has its unique traits. Understanding these distinctions will help us dive deeper into the world of financing. For sole proprietorships and partnerships, equity typically takes a straightforward form: capital, following the owner's name. For instance, if a partnership raised $60,000 from Penny and $40,000 from Dora, the equity entry is relatively simple like this. However, for corporations, equity is more complex and divided into two main segments: paid-in capital and retained earnings. Paid-in capital can further be categorized into various types, including common stock and additional paid-in capital. Corporations can issue different types of stock to raise capital, with common stock being a common choice. Each share of common stock has an assigned value, which may be termed par value if printed on the stock certificate, or stated value otherwise. It's important to note that the assigned value doesn't determine the market price of these common stocks. The distinction between the total funds received and the value of the common stock is referred to as additional paid-in capital. Now, imagine this. A corporation decided to issue 10,000 shares of common stock with a par value of $1 per share and received $100,000 from shareholders. What would be the common stock and additional paid-in capital? Pause the video and try to record this transaction. Welcome back. The total value of its common stock would be $10,000, calculated as 10,000 shares multiplied by $1. And it's left with $90,000 in additional paid-in capital. The entry for this transaction would be like this. Here we've unraveled the layers of equity, from the simplicity of sole proprietorships and partnerships to the complexities of corporations. Understanding these finer details is crucial for effectively navigating the financial landscape. Now let's discuss what an entity needs to pay out when raising money from equity. For a sole proprietorship or a partnership, owners have the flexibility to withdraw business funds for their personal needs at any time. This is commonly known as a withdrawal. For example, in a partnership owned by Penny Webb and Dora Taylor. If Dora decides to take $1,000 for her personal use, the entry would be recorded like this. However, in the realm of corporations, random withdrawals are not typical. Instead, they distribute dividends to their common shareholders. Okay, now picture this. On June 30th, a corporation announced a distribution of dividends of $5 per share. There were 100,000 shares of common stock in play. And on July 10th, it paid all the dividends in cash. How should we record these transactions? Now pause the video and give it a try. All right, let's walk it through together. When the dividends were announced, the total amount was $500,000. Since the distribution was only an announcement, dividends declared increased, along with an increase in liability to shareholders. So we debit dividends declared and credit dividends payable. When the dividends were paid in cash, we decreased the liability with a debit and decreased cash with a credit. Once again, we can see how the forms of ownership matter when it comes to equity accounting. All right, now we can move on to the debt funding. One common method businesses use to raise funds from creditors is by issuing bonds. A bond is a formal written agreement promising to repay the money borrowed. When it comes to bonds, the total amount that must be repaid is clearly stated on the face of the bond. This amount is known as the face amount or face value. For instance, let's consider the Dazzle Company, which received a cool $100,000 in cash by issuing 1,000 bonds with a face amount of $100 per bond. Now it's your turn to make the journal entry for this transaction. Pause the video, go ahead and give it a try. Pretty simple, right? The total amount of the bonds was $100,000. The issuance of bonds increased the bonds payable in cash, so we debit cash and credit bonds payable. When an entity issues bonds, it not only commits to repaying the face amount, but also agrees to pay interest to the bondholders. Think of this interest as the fee for borrowing money from bondholders, akin to rent for using their funds. It's a consumption too, so we need to recognize an expense for this called interest expense. Let's look at an example. On May 1st, Dazzle issued some bonds and promised to pay $3,000 in interest payments twice a year to the bondholders. On October 31st, Dazzle paid $3,000 as interest to the bondholders. Assuming June 30th marks the end of Dazzle's accounting period, how should we record these transactions? Take a moment to ponder this challenge. Now let's walk through this together. Firstly, we should calculate the interest expense for each month. To do this, divide the total interest by 6 months. On June 30th, we could recognize the expense for May and June. However, since the expense hadn't been paid yet, it created a liability of $1,000 called interest payable. When the interest is paid in cash to the bondholders, we should debit liability and credit cash. Plus, the interest expense for the remaining 4 months should be recognized too, accomplished with a decrease of $2,000 cash. Congratulations! You've learned how to account for 2 main financing activities, equity funding and debt funding. Go ahead and take your time to finish the related exercises. When you're ready, head over to the next episode to kickstart the next phase, preparing financial statements. I'm looking forward to seeing you there.